Assalamu alaikum. Have a good day. Today I'm going to start a new course, Strategic Management Accounting, shortly SMA. So, Strategic Management Accounting, that means a strategy, management, and accounting, the combination. So, I am Md.Monowar Hossain FCMA. I'm also the CPA, Cost and Management Accountant, Chartered Accountant, Certified Public Accountant, Certified General Accountant. So, in this course, we'll cover capital budgeting, advanced capital budgeting topics, responsibility accounting, transfer pricing, and decentralized organization, measuring organizational performance, total quality management, that's a key TQM, managing productivity, inventory management, and just-in-time, quantitative model and planning and control, management control, the balance scorecard, benchmarking, EMA and Six Sigma, strategic risks, operational risks, reputation risks, and compliance risks. I will cover all one after another. Today, in our module number 1, in my first module of SMA, that was strategic management accounting, we'll cover capital budgeting. So capital budgeting, an investment concept, capital budgeting process, cash flow estimation, capital budgeting evaluation method, discounting cash flow method, non-discounting cash flow method, the ranking of investment project, post-investment audit. So if we see that, principle of capital budgeting, that means incremental cash flow, opportunity cost, timing of cash flow, tax consideration, financing cost, overall, everything is covered with this principle. So if we see the capital is the stock of asset that will generate a flow of income in the future. And capital budgeting is the planning process of allocating all expenditure that will have an effective benefit, expected effective benefit to the organization for more than 1 year. So we can say capital budgeting is a tool of maximizing a company's future profits, since most companies are able to manage only a limited number of large projects at any one time. Capital budgeting, an investment concept. Investment refers to an outlay of fund on which management expects returns. Making decision having significant future benefit or cost of various entities and their stakeholders. So capital expenditure refers to long-term commitment of resource that provide future benefit of business. Why we invest? We invest for growth strategy, capacity building or increase, expansion of plant, expansion of facility, deploy fixed asset, copyright, licensing, patents, establishing new brands, new license, new products, new line, new office, new factory, overseas branch. That's why you need investment. So finance manager is concerned with planning and financing investment decision. Financing decision refers to determination of amount of long-term finance and decision of source for financing of them. Investment decision also turns to capital budgeting decision, involve cost benefit analysis. Investment decisions are based on careful consideration of factors like profitability, safety, liquidity, solvency, etc. So capital budgeting decision, we have to decide cost reduction decision, plant expansion decision, equipment selection decision, lease or buy decision, equipment placement consideration. Screening decisions whether a proposal project meets some present standards of acceptance. That means, should you accept the machine? Yes. If cost reduction permits the return 20% before tax, then we should accept the machine. Reference decision, that means which machine should replace an existing machine on the assembly line. We have to calculate the capital budgeting. So capital budgeting tools are NPV, IRR, MIRR, PI, that is profitability index, payback, etc. So we see that method of capital budgeting, there are two types, that are tradition and time adjusted method. Characteristic of business investment, most business investment involve depreciable assets, which have little or no resale value at the end of the useful life. Thus, any return involves such asset must be sufficient to provide the return on the original investment, return the total amount of the original investment itself. Time value of money. That means today's $1 is not equivalent to tomorrow's $1. Today is the purchasing power is more than tomorrow's. And one thing here, if we see, interest at 45,000 capital as yearly and 40,000 quarterly. So yearly, $1,000 if we keep in account, after 1 year we'll get 450 and total 1,450. That means in the second year opening, we'll get our balance will be 145. But see, the less interest, that means 40%, same principal amount, we can utilize it quarterly. In the first quarter, the 3 month, we'll get the interest 100, and first quarter end, it will 1,100. So this way, in the last 4 quarter, our balance would be 1,464 compared things. Though their interest rate is less than that. So we can calculate the future value, this formula, future value, and present value we can calculate by this way. So capital budgeting process, that means generating idea, analyze individual proposal, planning the capital budgeting, monitoring and post-audit. Complexity of capital budgeting process. There is a lot of complexity, but as you were a finance guy, It is easy to you because you know each and every point. The authority to make capital decision depends on the size, complexity of the project. Capital budgeting is allocation of fund to long-lived capital project. A capital project is long-term investment in tangible asset. Basic principle of capital budgeting: decisions are based on the cash flow. The timing of cash flows is crucial. Cash flows are incremental. Cash flows are on the after-tax basis. Financing costs are ignored. So, component of capital budgetings, we see that initial investment. Every capital budgeting required initial investment in the 0 year. Net cash benefit or saving from the operation and required terminal cash flow, maybe 0. The net present value technique, NPV. Here are some example for you. A company is studying as a feasibility accounting, accurating the new machine. This machine will cost $350,000 and have a useful life 3 years, and it will have no salvage value. That means 0. It is estimated that the machine will generate operation revenue 3 lakh and incurred 75,000 annual operating expenses over the useful life of 3 years. The project required an initial investment $15,000 and working capital will be recovered in the end of 3 years. The firm's cost of capital 16%, the firm's tax rate 25%. In this case, depreciation is not considered. So, if we see the solution of this problem, initial investment $350,000, it's okay. Initial net working capital needs, that means 15,000. Present value of the net cut after tax, it comes. That means we can make it easily calculation. That means 7 lakh minus 75,000. 1 minus 25, that is 1, that is tax rate, and present value 16 at 3 years. We will get 3 lakh 7,800, 3 lakh 38,996 dollar. So present value of the net working capital, that is 15,000, will get after 3 years the present value working capital reimburse, and net present value, that at that total, that means this figure and that figure minus initial investment and initial working capital investment, then we'll get the NPV, net present value, 23,605. Since NPV is positive, it is feasible to purchase the equipment. It is the decision. You, the finance guy or CFO, you will commit this decision. This decision you have to pursue management. Popular method of capital budgeting is NPV, we know, and also internal rate of return, IRR, and discounting cash flow, and sometimes it's maybe payback period also. In the cash flow estimation, we have to estimate That means estimating the cash flow is the most important part of the capital budgeting process. We have to remember it, and we have to learn a lot of techniques in this issue. Cash flow estimated is the most necessary to investment decision of any kind, new or expansion project, other cash flow estimation issues, replacement project. So in the project, there are expansion project or replacement project, or both, or maybe. So capital budgeting steps for forecast, estimates the cash capital, discount rate, NPV calculation, and then we have to calculate other things. Cash flow estimate, that means considering all factors will lie to others thing. So a cost is that has been incurred and may be related a project but should not be part of the decision accept reject. It's called the sunk cost. So incremental cost, opportunity cost, etc. Relevant cash flow. So basic principle of cash flow estimation: incremental principle, separation principle, post-tax principle, and consistency principle. So incremental principle, so where the cash flow of project must be measured in incremental terms. That is what amount is incremental. And separation principle, that means in this way we have to calculate two sides in the project. One is investment side, another financing side. For example, suppose a firm is considered a one-year project that require investment of 1,000 of fixed asset and working capital at that time zero. The project is expected to generate a cash inflow of 1,200 at the end of the year. The project will be financed entirely by the debt carrying interest rate 15% and the maturity after 1 year, assuming no tax here. So here two sides. One side is financing side, another side is investing side. Look, how we'll finance? We'll finance from bank or other things, 15% interest. So in the 0 year, we'll get $1,000, and after 1 year, we have to pay 1,150. That means cost of capital 15%. Okay. On the other hand, in investment side, if we see the investment side, in the 0 year, we are investing 1,000, but we will return after 1 year, we will get 1,200. Your rate of return is 20%. So when we calculate or learn capital budgeting, we have to consider these two things in this separation principle method. And because of the difference, cost of capital 15% and return 20%, so net 5% is the profit of that organization or the project. Post-tax principle, here have to consider all tax. That means cash flow should be measured on an after-tax basis. Consistency principle, we have to make it inconsistent. Initial investment, we have to calculate operating cash inflow and terminal cash inflow. Initial outlay, that means initial year, how much amount. Investment in non-operating working capital minus current liability. We will take it in another module. So we know the sunk cost, we know the opportunity cost. So another thing, that means source of fund or source of finance, source of fund, different way. That means based on period, it is a long term, mid term, short term. Ownership is owners, borrowing, and the generating, that is internal source, external source from the capital market, IPO, etc. So here are some today. Here is some problem, that means calculating working capital requirement. You can give take a snapshot from here, and it's your homework. Next module will solve that problem. Calculate the working capital requirement and evaluating change in the trade receivable policy. And problem 2, expansion type project. Please take a snapshot. And from the here, you will calculate NPV, PI, and which project you should take. Another problem, replacement type project, existing situation and proposed situation. This all today. Hopefully you will enjoy it. And from next module, I will conclude. This module would be a series module. So and every week I will release a new module. So thank you. Take care. We'll see you. Thank you. Goodbye. See you again. Thank you. Take care. Okay.